This is Nightly Business Report with Tyler Matheson and Sue Herrera.
Miserable Monday. Stocks head south to start the week, following oil prices lower as Wall Street keeps an eye on this week's Federal Reserve meeting and a raft of economic data coming out. McMuffin momentum. All-day breakfast helps jumpstart McDonald's sales, and investors are wondering if that turnaround is for real. And tech time. Big names, big reports due out. The ones investors need to watch. All that and more for Monday, January 25th. Good evening, everyone, and welcome. Tyler is on assignment tonight. It was another very rough session for the faint of heart on Wall Street today. Stocks were holding their own for a while, but a better than 7% sell-off in oil was too much, and things fell apart in the afternoon. The drop in crude after a few days of stabilization reignited growth concerns ahead of a big economic week. The Federal Reserve begins a two-day meeting tomorrow. And while no interest rate move is expected, the Fed's view and tone on the economy will be key. There is also a lot of data for investors to pore over this week, as well as about a quarter of the S&P 500 companies reporting their earnings. So growth was the focus. In the end, the Dow fell 208 points to 15,885. The Nasdaq dropped 72, and the S&P was off 29. Shares of Caterpillar were one of the biggest drags on the Dow after Goldman Sachs downgraded the Dow component to sell from neutral. The Goldman analyst is forecasting a sustained downturn in infrastructure spending due to the rout in commodities. Shares of Caterpillar were down 5% on the day. On the flip side, McDonald's was one of the best performers on the Dow today after the fast food chain saw global sales surge 5% and domestic sales did even better, up nearly 6%. The big catalyst? All-day breakfast. Shares gave back a lot of the early gains as the overall market sold off, but still managed to stay higher. Jane Wells has more on McDonald's strong report.
You know, I saw a new McDonald's billboard driving in this morning, which said, "Actions speak louder than words. Watch us." Well, McDonald's exceeded street expectations, both on sales and profits, with its best growth in nearly 4 years in U.S. stores open at least 12 months. Those sales up nearly 6%. The main reason? One word: McMuffin. Since all-day breakfast went national in October, CEO Steve Easterbrook says customers who might have gone elsewhere for lunch are coming to McDonald's to have breakfast for lunch, and people coming in for lunch are adding breakfast items.
All-day breakfast positions us to regain market share we've given up in recent years. In fact, since the launch of all-day breakfast, we've experienced positive weekly comparable sales gaps relative to our QSR sandwich competitors, and we ended the quarter with a positive gap of 2.9%.
Easterbrook says it's going to take another 6 months of steady growth before they move from turnaround mode to growth phase. McDonald's stock today hit an all-time high. Globally, sales growth not as impressive as in the U.S. Easterbrook said the terror attacks in Paris in November have had an impact in Europe. China, however, saw 4% growth in stores opened at least a year, and McDonald's plans to open 250 new stores in China this year, the most of any market. Other initiatives include here in the U.S., the McPick 2 menu, 2 items, $2. As Easterbrook says, 25% of McDonald's customers are all about price. They're also experimenting with delivering food to your table here in California, and the company will improve its app so that it actually adds to sales this year. And finally, management plans to give shareholders back $14 billion in dividends and share repurchases in 2016. For Nightly Business Report, Jane Wells, Los Angeles.
Our guest tonight owns more than 600,000 shares of McDonald's, and he says this feels like a turnaround for the company, and he envisions long-term changes in its growth pattern. Joining us is Joseph Zock, portfolio manager with Tocqueville Asset Management. Joe, welcome. Nice to have you here.
Good evening, Sue.
You bought this stock when the street did not love it at all, so you've had a nice gain in this particular position that you own. Tell me what you think about the report that we had today, and you say it feels like a turnaround to you.
Well, it's a bit surprising that the initiatives took hold so immediately, but this is really a long-term story where McDonald's has been grappling with two things: changing consumer tastes, and they've had a decade of horrible public relations that they had to overcome. But the changes are underway, and a change in management was the first thing that caught our eye.
Steve Easterbrook has been such an interesting CEO to watch because everybody discarded this stock, even though it had a really decent dividend and still does. Are you confident that the initiatives that he has put in place, for example, the expansion in China, will continue to power the stock higher?
Yes, and he's done everything that a normal manager would do. And when I say normal, if you're in the retailing business, you want to know what your customers think, you want to listen to your franchisees, and you want to have the courage to make those changes. So the Egg McMuffin is just the beginning of the changes that he'll initiate, and expansion is an important part of McDonald's game plan.
There are some who feel, though, that the aggressive expansion in China might be a little bit risky because that economy has been slowing down.
Right. Well, as you know, many years ago, people bought McDonald's as a defensive holding in their position because consumption of food was something that really didn't move with the economic sensitivity that other companies did. So I think he's taking a very cautious approach and starting with a very limited menu. So I think it's a massive market that should be approached.
Speak to me about what you call the under-leveraged balance sheet and also the dividend, which you found very attractive.
Right. Well, when we first bought the stock, really our clients pushed away from the table and said, are you crazy? McDonald's is just not something that we want to have in our portfolio. When we made the case, we showed them the balance sheet and asked them to imagine if this were an industrial name or a manufacturing name. And that helped them overcome that, especially in this environment where energy stocks are over-leveraged and under pressure. However, the dividend was something that we could also point to because at the time, treasuries were yielding much lower numbers. And while we waited for this turnaround to take place, it was a reasonable proposition.
Are you at all worried about the dividend near term? There are some companies who are cutting it. McDonald's has not been on that list, obviously, because the stock has been doing so well.
The stock's doing well. They can easily cover the dividend payment. And it's something that, once again, Steve Easterbrook has pronounced that he will not back off on that. So when a company steps up to the microphone and says they want to give shares or money back to shareholders, we view that as an exclusively positive thing.
All right. Thanks for spending time with us tonight, Joseph.
Thank you, Susan.
Joseph Zock with Tocqueville Asset Management. And as the market slides, and we're currently in correction territory, there is a popular strategy called buy the dips. It's essentially looking for bargains in the stock bin. And as Dominic Chu tells us, it's not a strategy that just the pros can take advantage of.
Picking tops and bottoms in the stock market is no easy task, and you'd be hard-pressed to find anyone who can do it with consistency. The recent market downdraft in stocks has left some wondering, though, whether this is the time to invest.
We've just had stocks go on sale 10% or even more for individual securities. So absolutely, I think a long-term investor should be taking advantage.
So, where are some investors looking for bargains? Some are looking at relative winners over the past year that have taken a dip recently. Among members of the large-cap S&P 500 index, only around 10 stocks have posted gains over the past week of 5% or more and still have positive returns over the past 12 months as well. Among them, names like Verizon, also Nike, McDonald's, and Amazon.com. Each have seen buying on a shorter-term basis and have managed also to hold on to gains longer term. Others, though, are looking for potential winners in places that have been relative laggards up until now, a potential reversal of current trends.
I think there's going to be a lot of change. I think international markets will do better than domestic. I think industrial and producer stocks will do better than consumer stocks. I think small caps may do better than large caps. In other words, it's not just about finding a market bottom. I think the entire leadership of this bull is changing here as we go forward.
Now, the bulls do have a case. After all, markets have managed to rebound sharply since the financial crisis. However, caution remains a big theme among experts, with slowing economic growth around the world and the potential for large market shocks that haven't been seen yet in 2016. Understanding one's risk tolerance will be a big part of any buy or sell decision in the market. For Nightly Business Report, I'm Dominic Chu.
Meantime, the downturn in oil prices continues to take its toll. Halliburton posted a loss in its last quarter. The country's second largest oil field services provider was hurt by a steep decline in its North American business. Revenue at the unit was cut by more than 50%. Shares were off 3%. And that drop in oil is having ripple effects throughout the economy. Business activity tied to oil and commodities is one of the biggest pressure points. As energy and mining companies cut back on spending, the manufacturing sector is feeling the pain. Morgan Brennan takes a look at the damage and whether it might get worse.
More signs that depressed oil prices are taking a toll on manufacturing. Today, the Dallas Federal Reserve saying business activity in Texas has tumbled to the lowest level since the recession of 2009, much worse than expectations. According to analyst Peter Bukvar, the, quote, data speaks for itself and reflects the major recession the energy patch is in and the ripple effect on other industries. It's the latest sign that energy companies aren't the only ones feeling the adverse effects of the crude price collapse. It's a dynamic that has Deutsche Bank chief U.S. economist Joseph Livornia concerned.
Investors need to be worried about the manufacturing sector because even though it's a very small piece of the overall economy, it tends to be a very leading indicator of what happens to the overall economy.
Livornia adds that with an economy growing at 2%, the risk of broader recession is much higher than if economic growth were more robust. And that it isn't just oil prices pressuring the sector either.
A portion of the manufacturing sector is oil, but I think equal parts also include the fact that the U.S. dollar has had one of its strongest rises on record. And thirdly, we have a pretty sizable inventory correction we're working through.
Nonetheless, as energy companies slash spending for a second straight year, that's translating into less business for a variety of industries. From miners that supply sand needed to frack oil wells to steel makers like U.S. Steel, which plans to lay off hundreds more workers in Texas, to transportation equipment makers like Greenbrier Industries, which saw railcar orders plunge 80% last quarter from the 3 months prior. Wells Fargo analyst Justin Ward says the Architectural Billings Index is also flashing a warning sign, with industrial construction close to, quote, recession territory. The sector typically leads broader building activity and is thus likely the first to signal a downturn. Analysts will be focused on all of this as earnings season plays out, with companies including U.S. Steel, Norfolk Southern, Caterpillar, and Freeport-McMoRan reporting this week alone. The expectation that the energy downturn will once again drag down results and that businesses are hunkering down for another rough year. For Nightly Business Report, I'm Morgan Brennan.
Coming up, it's a big week for earnings, as we've said, but in particular for technology. The key reports to watch when we come back. The East Coast continues to dig out after this weekend's blizzard that buried the region under several feet of snow. Slowly, things are getting back to normal as streets continue to get plowed. Amtrak is up and running, albeit on a limited schedule, and planes are once again taking off at the airports after the storm forced the cancellation of thousands of flights. Another multi-billion-dollar inversion deal, this time with two industrial names, and that's where we begin tonight's market focus. Johnson Controls and Tyco have agreed to merge in a deal valued at more than $30 billion. Johnson, which makes automotive seating and air conditioning equipment, among other things, will own 56% of the company and will keep its name while moving headquarters to Ireland, where Tyco is domiciled. Tyco makes fire protection and video surveillance systems. Shares of Johnson Controls dropped 4% to $34.21. Tyco soared nearly 12% to $34.15. Sprint is reportedly cutting about 2,500 jobs as part of its efforts to slash about $2.5 billion in costs. Most of those layoffs are coming by closing call centers. It is the third round of cutbacks in the last year and a half. Shares of Sprint fell 12% to $2.52. Consumer products maker Kimberly-Clark missed targets for both its earnings and its revenue numbers as a strong dollar and falling global currencies hurt the company's results. The maker of Huggies and Kleenex said due to significantly unfavorable currencies, net sales will likely come in flat to down again this year. Kimberly-Clark shares were off 3% to $122.69. And D.R. Horton posted a slightly better than expected profit, but it saw its home building revenue grow at its slowest rate since 2011. The nation's biggest home builder did see a rise in orders in that quarter, which is an indicator of future revenue. D.R. Horton, though, fell nearly 5% to $26.40. The Supreme Court threw out a ruling in favor of Amgen employees who said that they lost money in the company's stock ownership program. The original lawsuit from 2007 said the value of the plaintiffs' retirement plans fell when Amgen stock dropped. It was revealed the company concealed negative clinical study results of an anemia drug and marketed it for off-label uses that were unsafe. The court said the original ruling was incorrect, and it sent the case back to the lower courts. Shares of Amgen fell more than 1.5% to $153.43. As we mentioned just a bit earlier, about a quarter of the S&P 500 is scheduled to report earnings this week, and it's a big week for some of the titans of technology. Josh Lipton takes a look at why Wall Street will be particularly focused on a trio of the big names.
It has been a tough start to the year for tech. Sector is down some 7%. 33 tech stocks, or nearly 50% in the S&P 500, are in bear market territory, meaning a drop of at least 20% from a recent high. Investors are concerned about global economic growth, and that's a problem for tech, given that 60% of the sector's revenue comes from overseas. Despite the sector's drop, though, investment strategists remain on the sidelines for now.
The sector doesn't look cheap at these levels, even though we have seen a bit of a price decline, primarily because earnings are expected to grow pretty much in line with the overall market, and also the worries persist as to what will be happening overseas and how that will reflect on this highly international sector.
Now investors await 3 critical reports from big technology companies that will give a better indication of how tech performs from here. The first is Apple, which will report earnings tomorrow after the close. Already, that stock is down around 20% in the past 6 months as investors worry about iPhone growth in the quarters ahead. Still, some analysts argue that the stock could move higher this year on new products and strong buybacks. Also, will CEO Tim Cook continue to sound as bullish about the company's business in China, given that economy's slowdown? Mainland China now accounts for some 30% of Apple's revenue. Then on Thursday, Amazon reports. That stock is down about 10% this year, but it's up more than 90% over the past 12 months. RBC's Mark Mahaney, an Amazon bull, says he'll focus on unit growth, the key retail metric, which he thinks will jump more than 20%, as well as whether the company's cloud business maintains strong momentum. Amazon has a lot of supporters on Wall Street. 65% of financial analysts covering the company rate it a buy. And finally, investors are fans of Microsoft CEO Satya Nadella and the powerful cloud business he has built. That stock is up some 10% over the past year. But Intel's latest earnings report highlighted weakness in the PC market, which could spell a challenging quarter for Microsoft. We'll know more when the company reports results on Thursday. For Nightly Business Report, I'm Josh Lipton in San Francisco.
So let's turn now to our next guest, David Garrity, to talk more about tech earnings and the ones that he says investors should be watching closely. He is principal of his own tech firm, GVA Research. Good to see you again, David. Welcome back.
Thank you, Sue.
Let's start with Apple. Are you one of those out there that thinks that this is a make or break quarter for Apple?
I would say in terms of looking at Apple, I mean, the stock clearly is trading at very, very low valuation relative to earnings, whether you adjust for cash or not. And certainly when you have a low multiple on a company such as Apple, I think the market's already factored in its own concerns around the products. Going forward, if we look into September of 2016, we will have the introduction of the new iPhone 7. And from that standpoint, that probably should help to jumpstart growth going in towards the end of the year. So if there is a pullback here on Apple coming off the December quarter results, we would think it was being an attractive time to perhaps consider establishing a position or adding to an existing position.
All right, let's move on to Facebook. And everybody's going to be watching the Instagram part of Facebook.
In terms of Facebook, again, the stock has not been immune to the downturn in terms of the overall market, and that in the technology sector in particular. Instagram certainly has been something to help drive traffic to the Facebook site, but I think investors are going to be looking at how well Facebook is doing in terms of their audience engagement and how that's serving to drive their own advertising revenues on a global basis. One thing we'd also say to Facebook is that unlike Apple or other companies in the technology sector, Facebook has no operations in China. So from that standpoint, should be immune in that regard.
What about Microsoft, David? Because everybody's kind of watching management and how they're positioning this company in an ever-changing world, you know, the cloud and things like that. What are you going to be watching for?
certainly in terms of Microsoft, I mean, people might have raised some concerns about how, with regards to the Windows 10 software upgrade, the company is deciding not to charge, essentially to bring the user base up to a fully current level to the extent that they can. We think that, though, that if investors have been very much encouraged about the move to the cloud, certainly it's something that's worked well for Amazon. People have to know that Microsoft is actually number 2 behind Amazon in terms of their cloud-based operation, and it's the growth in that area that clearly is going to be driving stock price returns over the balance of 2016.
All right, I have 30 seconds left. Let's try and squeeze in eBay. What are you going to be looking for?
In terms of eBay, I mean, the company spun off the PayPal operations. The concerns that we have in terms of eBay, if we look at the scale of competitors such as Amazon, are we going to find that volumes are down substantially? Are there other e-commerce companies out there that are doing a better job of engaging with consumers and driving their use on eBay? So there, we're not so sanguine.
All right. David, great to see you again.
Thank you.
David Garrity with GVA Research. Competition from the likes of Uber and Lyft are becoming too much for some traditional transportation companies. Can these two worlds coexist? That's next. Exchange-traded funds, better known as ETFs, have grown in popularity, so much so that some even consider them their own asset class. The biggest and brightest from that industry are gathering to explore many topics that could impact investors in those funds. Bob Pisani has more from Hollywood, Florida.
Market volatility was the hot topic at the ETF.com conference, with the CEO of Vanguard telling investors to stay the course.
We're telling investors that this volatility may be with us for a while, but it's very important to stay diversified, keep a long-term perspective, and so far the behavior is actually reinforcing that.
3 other hot topics here. First, smart beta. ETFs weighted some other way than market capitalization. Goldman Sachs made a big splash last year with 3 ETFs that weight by value, momentum, quality, and low volatility. The big question is, do they really outperform market cap weighted indices? The jury is still out on that one. Second, active management. So much money is coming into ETFs that it has attracted the active management crowd that insists that they can outperform passive index funds. The industry is split on this. Half say, who needs them? We don't need them. But the other half says there's plenty of room for other investment styles. Finally, is the SEC going to tighten regulation of ETFs? They recently announced that they would be looking into the suitability for investors of complex ETFs, like leveraged and inverse ETFs. And they're also looking at limiting the amount of leverage that could be used in an ETF portfolio. For Nightly Business Report, I'm Bob Pisani at the ETF.com conference in Florida.
San Francisco's largest taxi company, Yellow Cab Cooperative, has filed for bankruptcy as the company faced a steep drop in passengers as it faced tough competition from the likes of app-based services like Uber and Lyft. Last year, Chicago's Yellow Cab service filed for bankruptcy, citing app-based transportation network. So will other taxi cab companies file for bankruptcy in other cities around the country? Let's find out from Mitchell Moss, director of the Rudin Center for Transportation at New York University. He joins us now. Welcome. It's nice to have you here.
Thank you. Glad to be with you.
I guess that is the question. How prevalent is this going to become, do you think?
Well, we should not generalize from San Francisco. Everyone loves the city of San Francisco. It's beautiful. It's spectacular as a place to visit. But the cab service has historically been terrible there. It's hard to hail a cab on the street, very expensive when you get in. It's no surprise that Uber and Lyft have taken over most of the for-hire service because the taxi industry there has not been very responsive.
But what about Chicago?
Well, Chicago, I think, is a different case. There have been many different cabs, but I think companies there. But I think the first part to understand is that in Chicago, there are so few people who want to drive a cab now that the mayor is actually having an American Idol kind of competition to get a cab driver and giving away a free medallion. This is because across the country, we're finding out that the taxis have had a franchise, a monopoly position, and when people are getting better service at lower cost through Uber and Lyft, they're preferring it. And San Francisco, by the way, I should point out, has had a kind of a bankruptcy filing, largely because they've had millions of dollars in judgments against them that have been filed, and when the courts have awarded the plaintiffs damages. And so it's not just due to Uber, it's due to the fact that this is a co-op, it's a particularly different kind of version. I think you're also finding out across the country that there are many individuals who would rather pay less for better service. Certainly, you don't take a taxi to go to Los Angeles International Airport anymore. It's far better to take Uber or Lyft or one of the other alternatives because it's quicker, it's cheaper, and certainly the market has now entered the area of mobility for hire service. Up until now, we've had a monopoly. In many cases, the city's police departments regulated them. Unfortunately, taxi companies may be going out of business, but taxi drivers are switching to drive Uber and Lyft where they have better arrangements. This is a different case, though, in New York, let me point out, where the Taxi and Limousine Commission is very smart, very sophisticated, and they have both Uber, Lyft, for hire, green taxis, and the yellow taxis coexisting.
Is that the message then? You know, you have to be nimble, you have to give good service, you have to keep your prices low, certainly. But how is this all going to impact mobility in those urban areas? It doesn't sound like you think it will in New York because of the variety.
Mobility is getting better. Look, many people I know are much more comfortable having an Uber where you press a button on your phone, it comes to your immediate location, than to get out on a street and try to fight for a taxi or call someone and never know when the person's going to pick up the phone, answer it, or send a cab. And I think we have to realize that in New York, we have licensed car companies, licensed taxi drivers. We inspect the cars. Other cities are going to have to do the same thing. But it's clear that people are voting to choose mobility, which is coming out of their cell phone.
Mitchell Moss with New York University's Rudin Center for Transportation, thank you. And that will do it for Nightly Business Report for tonight. I'm Sue Herrera. Thanks for joining us. Have a great evening. We'll see you tomorrow.